Hey, hi chatters, hope you are all doing great. In today's video, we are diving deep into an essential financial concept that is crucial for the students pursuing their careers in CA, ACCA, CS, and BCom. We are talking about the debt service coverage ratio, popularly known as the DSCR. So, if you are ready to understand the ins and the outs of the DSCR, make sure to hit that like button and subscribe for more educational content. Let's get started. So, before we dive in, let's establish what DSCR is. Let's understand its significance. So, basically, the DSCR, the debt service coverage ratio, forms part of the long-term solvency ratio, and it measures the ability of the firm to meet its various debt services. When we talk about debt services, we are talking about the two elements that are, can anyone name them? That's great. Exactly, interest payment and principal repayment. For the students pursuing CA, the ICA module has written it as installment. Okay, so in case of any queries or any doubts regarding this, so installment basically is used synonymously for principal repayment. Now let's break down the formula for the DSCR, debt service coverage ratio. So, debt service coverage ratio has got two basic formulas. First of all, we will be writing them down, and then we will be understanding each and every formula. So, basically, there are two formulas for DSCR. These two formulas come from two different school of thoughts, from two different approaches. Okay, so first of all, let's write down the formula, then we will be understanding the two approaches. Okay, so formula number 1 states that DSCR is equal to EAT, that is nothing but what we call as the net profit. EAT, earnings after tax, or profit after tax, or net profit, one is the same thing. Okay, so in this EAT we have to add back the interest. By adding back the interest, what we are doing, we are nullifying the effect of the interest element, of the interest expense, and then we add back depreciation and amortization expense. Okay, so basically DSCR states that how much operating cash flows we have. So this is one of the most important learning that you guys will be taking today. DSCR talks about the operating cash flows. Always remember this thing, that DSCR is talking about the operating cash flows. I hope you guys must have once in your life you might have studied about this CFS, cash flow statement, right? So using the indirect method, I guess, using the indirect method, what we used to do, we used to add depreciation and amortization under the category of non-cash, non-operating expenses, just to arrive at cash flows from operations. Okay, so adding back this depreciation and amortization expense has just a sole purpose, and that is to serve our basic condition for the DSCR, and that is operating cash flows. Okay, earnings after tax plus interest plus depreciation and amortization. So this is giving a coverage to the debt services. And what are the debt services? It is interest plus installment, or basically we can say principal repayment. Okay, and the second approach, the second school of thought, give the second formula, and which is like DSCR is equal to cash or funds from operations, and this is giving the cover to the debt services in form of interest and principal repayment, which is nothing but installment for the CA students, right? So what actually is cash or funds from operations? This is before interest and tax. So what is cash or funds from operation before interest and tax? Let's have an understanding. Okay, cash or funds from operations before interest and tax basically means EBIT or PBIT. Can anyone please answer me in the comment section what is the other name for EBIT or PBIT. And what we are adding back? We are adding back depreciation and amortization expense, because we are targeting what? We are targeting funds from operations, right? Operational cash flows, right? So EBIT plus depreciation and amortization divided by interest and principal repayment, right? So basically, can we write the numerator as PAT plus this depreciation and tax plus interest? I hope everybody understood this. Then depreciation amortization. In case you guys didn't understand this, let me just give you a brief explanation for the same. So what we do from EBIT, what we do? We reduce the interest expense, right? The remainder is what we call as the, very good, EBT, and EBT is what we call as the pre-tax profit. And as far as EBIT is concerned, it is also known as operating profits or operating income, right? From this we reduce the tax and we get what? We get PAT, EAT, or simply what we can call as net profits. Okay, so in the PAT, EAT or net profits, by adding back the tax we get EBT, that is the pre-tax profit, and by adding pre-tax interest to the pre-tax profit or EBT we get EBIT, operating profit, right? So what we did, instead of writing EBIT we wrote PAT plus tax plus interest, right? And we got EBIT, and then we divided the same by the debt services in form of interest and principal repayment, right? So if you guys are able to understand this, so over here let's just write PAT for the better understanding. Okay, so if you guys are able to understand, we got the two formulas for DSCR. Let me just place them side by side for a better understanding. So first of all, these two formulas are not the same. If we look at the first formula from the first approach, from the first school of thought, it says that DSCR is PAT plus interest plus depreciation and amortization. But the second formula states that DSCR is PAT plus tax plus interest plus depreciation and amortization. So according to one approach we are adding back tax, and according to the other we are not adding back the tax element. So why so? So according to this approach, so this approach states that tax is an ongoing cost of business. Please everyone will note down, tax is an ongoing cost of business. So basically this approach states that if we are entering into a business, we definitely have to pay taxes, and by adding back the tax, what we are doing? We are nullifying its effect, and by adding back or by simply nullifying the effect of the same, we are not showing the true picture. We are not showing the true picture of the same. So for that reasons they are not adding back the taxes. But according to the second approach, according to the second school of thought, it states that taxes are not that important, they are not relevant, they are not that relevant to understand the basically the earnings available or the cash flow before interest and tax for the debt services. It is not that important. So basically what they are doing, they are adding them back. So by adding them back, what they are doing, they are actually nullifying the effect of the same. Okay, nullifying the effect of taxes, right? So two different school of thoughts, two different approaches, they gave two different formulae or formulas, right? So since these two formulas aren't the same, the answers for the DSCR from these two formulas will not be the same. This is one of the most important understanding. So two different approaches, two different formulas, two different answers for the one single ratio, and that is the debt service coverage ratio, popularly known as the DSCR. So in case for the CA, CS students, BCom students specifically. In case you guys get this question in your examination, what will you be doing? Which approach will you guys be following? If you ask me, this approach is far better than this approach. That's my viewpoint. That's my POV, right? But as far as your examinations are concerned, you guys need to write an assumption. You guys need to write a proper assumption wherein you will be stating that apart from this formula or this formula, whichever you choose, you have to write that there is another formula, and you have to specifically write the formula for the same, right? BAT plus interest plus depreciation and amortization. In case you have opted for this formula, then write taxes. In case opted for this formula, do not write taxes, but you have to write the formula. Okay, so this was it for today. I hope you guys enjoyed the video, and there you have it, a comprehensive overview of the debt service coverage ratio, popularly known as DSCR, tailored to CA, ACCA, CS and BCom students. Remember that there's more than just a formula. It's a valuable tool that can help you to make informed financial decisions in your future career. If you have found this video valuable or helpful, don't forget to give it a thumbs up and share it with your fellow students. Thanks for watching, and I will see you in the next video. Till then, take care. Goodbye.